Almost everyone eventually asks the same question. Should I build wealth through stocks, or should I build wealth through real estate? It sounds like a simple question, but the first thing I would ask back is not which one is better. I would ask, why are you asking now? That answer usually tells me more than the question. Most people do not wake up one morning after calmly studying asset classes, liquidity, tax law, risk management, leverage portfolio construction, and their own temperament. They usually ask because something entered their field of attention. A friend made money in stocks, a relative bought a rental property, somebody at work started talking about house hacking, a neighbor got rich during a market rally, someone on the internet showed a screenshot. Suddenly, the person feels like they are behind. That is not strategy, that is attention being hijacked. There is a name for this phenomenon. It is often called the Bader, Meinhof phenomenon, or frequency illusion. Once something becomes relevant to your mind, you begin seeing it everywhere. It was probably always there, but now your brain has started filtering for it. If you start thinking about buying a certain truck, you suddenly see that truck on every road. The trucks did not appear overnight. Your attention changed. Investing works the same way. Once stocks become relevant, you notice stock stories everywhere. Once real estate becomes relevant, you notice real estate stories everywhere. Once you hear someone is making money in short-term rentals, you suddenly see that strategy everywhere. Once you hear someone bought Nvidia early, you start seeing every artificial intelligence stock as a missed opportunity. The danger is that attention can feel like evidence. It is not. Just because your brain is seeing real estate everywhere does not mean real estate is the right first move for you. Just because stocks are being discussed everywhere does not mean you should jump into whatever is hot. Attention is a signal that your brain is interested. It is not a complete investment thesis. But frequency illusion can also be useful if you understand how to use it. The right way to use it is not to chase what suddenly feels visible. The right way is to create deliberate relevance. That is why I usually tell people to start with stocks, not because real estate is bad. I like real estate very much. Real estate is one of the greatest wealth-building tools in the tax code when it is used correctly. It can create cash flow, leverage, depreciation, tax advantages, control, and generational wealth. I have seen real estate create extraordinary outcomes for disciplined investors. But if a person is just beginning, I usually want them to start where the downside is less likely to destroy them. Stocks do that better than direct real estate. The moment you buy a share of a company like Coca-Cola, something changes before owning it. The company may have been just a brand after owning it. Your brain begins to pay attention. You notice earnings, you notice the dividend date, you notice the price to earnings ratio, you notice revenue, you notice margins, you notice whether the dividend has grown, you notice whether analysts are positive or negative. You notice the company in the store, in restaurants, in headlines, and in your portfolio. Ownership makes the abstract concrete. This is how real learning begins. People often believe they need to watch endless videos before investing. They think they need to understand everything before starting. They read more threads, listen to more opinions, and delay action because they are waiting to feel ready. But competence is not built only through passive learning. Competence is built by having a small amount of skin in the game and then paying attention. When you own something, your mind says, this matters now. That does not mean you should gamble. It does not mean you should put your life savings into a company you do not understand. It means a small, deliberate position in a quality asset can teach you more than hours of detached content consumption because the lesson becomes personal. In many areas of life, a focused 20 hours can make someone competent enough to stop being a blind beginner. Not an expert. Expertise may take thousands of hours, but basic competence can come much faster when attention is focused and the stakes are real enough to matter. Stocks can be an excellent training ground for that. If you buy a small amount of a high-quality dividend-paying company, you are not only trying to make money, you are learning how money behaves. You are learning what revenue is. You are learning what profit is. You are learning what a dividend is. You are learning what valuation means. You are learning how markets react to earnings. You are learning how your own emotions react to price movement. That last part may be the most important. Investing teaches you about yourself. A person can say they are long-term until a stock falls 15%. Then you learn whether they actually understood what they owned. A person can say they are comfortable with volatility until the account is red. Then you learn whether they had a plan or only a preference. Stocks allow beginners to learn these lessons with smaller mistakes. If I buy shares in a company and I am wrong, the most I can lose is the money I put into that position. That is not pleasant, but it is bounded. If I buy a rental property and I am wrong, the loss may not be bounded in the same way. A bad tenant can refuse to leave. A tenant can damage the property. The roof can fail. The air conditioner can die. Insurance can increase. Property taxes can rise. A mold claim can appear. A lawsuit can happen. Vacancy can last longer than expected. And while all of that is happening, the mortgage payment continues. That is why sequence matters. The question is not whether real estate is good. The question is whether direct real estate is the right first learning environment for a person without liquidity, reserves, competence, and a margin of safety. For many beginners, it is not. This is a principle. Do the thing that can teach you while being least likely to wipe you out. That is why stocks often come first. Liquidity is the first reason. If you buy a stock today and need money 3 months from now, you can usually sell the shares and have cash in a short period of time. There can be losses, taxes, and timing issues, but the asset is liquid. If you buy a rental property and need money 3 months from now, the situation is very different. Selling can take months. Transaction costs are high. You may have to lower the price, the property may have tenants, the buyer may demand repairs, financing may fall through, you may be forced to borrow against the property or sell into a bad market. For a beginner, liquidity is not a luxury, it is protection. Liquidity gives you room for error. It prevents a small mistake from becoming a forced sale. It gives you optionality. It allows you to adjust without being trapped. Panic destroys wealth. Liquidity reduces panic. This is especially important early in the journey because beginners make mistakes. Everyone makes mistakes. The question is whether the mistake is survivable. In stocks, a bad first lesson may cost money. In real estate, a bad first lesson can damage your whole balance sheet if you are undercapitalized. That is why liquidity matters so much. The second reason is the learning curve. Many people think real estate is easier because they can touch it. You can see a house. You can walk through it. You can understand that people need a place to live. That makes real estate feel simple. But feeling simple is not the same as being simple. Understanding what a house is and understanding real estate investing are two different things. Real estate done well requires market knowledge, financing knowledge, reserve planning, capital expenditure planning, tenant screening, maintenance, property management, insurance, vacancy assumptions, legal structures, local regulations, landlord-tenant law, tax rules, depreciation, cash flow, debt service, and risk management. If you get one of those wrong, the mistake can become expensive quickly. A house is simple to see. It is not simple to manage. Stocks can also be complex, but a beginner can start with high-quality dividend. Paying companies and learn in smaller increments. You can buy a small position, you can study the company, you can watch the earnings, you can learn what matters, you can add gradually, you can sell if your thesis changes, you can make mistakes without taking on a mortgage, tenants, repairs, and lawsuits. That is why I would start with quality, boring companies. Not gambling, not a hot tip from a brother-in-law, not a stock someone mentioned at the gym, not a speculative company that may or may not exist in 5 years. Start with companies that have proven they can make money, pay dividends, and raise those dividends over long periods. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years. Dividend kings have increased dividends for at least 50 consecutive years. Think of companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, and other long-operating businesses with durable demand and shareholder return discipline. These companies are not guaranteed, no stock is guaranteed, but they provide a useful classroom. They teach you how stable businesses behave. They teach you how dividends work. They teach you how valuation matters. They teach you how investor expectations move prices. They teach you what it feels like to be an owner. The goal in the beginning is not to hit a home run. The goal is to become competent. A beginner should use filters. Does the company pay a dividend yield above a reasonable minimum, perhaps 2% or more? Has the dividend been consistent and growing over a meaningful period? Is the company's revenue stable or growing? Is the price-to-earnings ratio reasonable, perhaps in a range that does not suggest extreme overvaluation? Is the stock in a stable or upward trend rather than collapsing? Are there options available so a more advanced investor can eventually use strategies like covered calls or cash? Secured puts are analysts, while not always right, generally more positive than negative. Is the business understandable enough that you can explain how it makes money? The exact filter can vary. The point is to use a filter. A system protects beginners from chasing stories. Without a system, the mind follows excitement. With a system, the mind checks evidence. This is how stocks become a school. You learn the vocabulary because it becomes relevant. The price-to-earnings ratio is no longer an abstract concept from a finance book. It is the valuation of something you own. The ex-dividend date is no longer a strange term. It is the date connected to your cash flow, revenue, profit, payout ratio, debt, free cash flow, and guidance all begin to matter. Because you have ownership. That is how competence is built. Now, I want to be very clear. Starting with stocks does not mean avoiding real estate forever. That would be wrong. Real estate has some of the best tax advantages available to ordinary investors if they learn how to use it properly. Depreciation can offset income. Bonus depreciation may create significant deductions in some structures. Leverage can magnify returns. A well-bought property can produce cash flow and appreciation. A 1031 exchange can defer capital gains. Step up in basis can help families pass appreciated property to heirs with enormous tax advantages. Borrowing against appreciated property can create liquidity without triggering sale taxes. These are powerful tools. But powerful tools can hurt the person who does not know how to use them. A chainsaw can cut wood quickly. It can also injure a careless beginner. Real estate is like that. It is not bad. It is powerful. That is exactly why sequence matters. I have seen people save $20,000 or $30,000, watch a few videos, get excited, and buy a cheap rental in a market they do not understand. Then the tenant stops paying, the roof leaks, the air conditioning system fails in the summer, property taxes increase, insurance changes, the property manager underperforms. The house cannot be sold without taking a loss. The person's entire cash cushion is now trapped inside one property. That is how beginners get hurt. The property may have looked affordable. The real cost was hidden in reserves they did not have. This is why I would not start direct real estate without enough capital to survive normal real estate problems. A roof is not a black swan. A broken air conditioner is not a black swan. Vacancy is not a black swan. Bad tenants are not impossible surprises. These are normal probabilities in real estate. If a normal probability can destroy you, you are undercapitalized. That is a very important principle. A good investment is not good if you cannot survive its normal problems. Now, if someone is strongly drawn to real estate early, there are smarter ways to begin. The first is house hacking. This means buying a property you live in and using part of it to generate income. It might be a single-family home with extra bedrooms. It might be a duplex, triplex, or small multifamily property where you live in one unit and rent the others. It might be a basement apartment. It might be a structure where roommates help cover the mortgage. The reason house hacking can be smart is that it combines your housing need with an investment education. You need a place to live anyway. If part of the property helps pay the mortgage, you learn landlord behavior with training wheels. You have skin in the game, but you are not necessarily jumping into a distant market with no control. You are closer to the asset. You can see problems. You can learn tenant management. You can reduce your own housing cost. It is not risk-free. Nothing is. But it can be a more controlled entry into real estate than buying a distressed rental far away because someone online made it sound easy. The second real estate entry path is the live-in improvement strategy. You buy a primary residence that needs work, you live in it, you improve it. After living there for at least 2 years, you may be able to sell and exclude a significant amount of capital gain from federal tax subject to the rules. For a single person, the exclusion can be up to $250,000 of gain. For a married couple, it can be up to $500,000 if the requirements are met. This can be one of the most powerful wealth building provisions in the tax code for ordinary households. You are not flipping a property as an outside investor. You are living in it. You are getting utility from it. You are improving something you use. If you do this carefully over a decade, moving every few years and improving homes, you can build meaningful capital while reducing taxes on the gains. This strategy still requires work. It requires buying well. It requires understanding renovation costs. It requires patience. It requires living through improvement. But it reduces some of the risks of jumping straight into traditional rentals because the home is also your residence. The third way to get real estate exposure early is through REITs. A real estate investment trust allows you to own exposure to real estate through a publicly traded security. REITs can own apartments, shopping centers, industrial property, warehouses, data centers, cell towers, healthcare properties, storage facilities, offices, and many other asset types. They often pay dividends because of their structure. REITs give you real estate exposure with stock-like liquidity. That is valuable for a beginner. You can learn how real estate behaves. You can study funds from operations. You can understand occupancy, lease terms, debt maturities, cap rates, interest rate sensitivity, property types, tenant quality, and dividend coverage without trapping your entire first capital base in one physical property. A REIT can fall in price. It is not safe simply because it is liquid. But the liquidity means you are not trapped in the same way. You can start with smaller amounts, you can diversify across property types, you can learn the economics of real estate before owning direct rental property. This is a good bridge if you are determined to own real estate. REITs can be a classroom before you buy the building. Now, there is a broader allocation model that makes sense for durable wealth. One way to frame it is 30-30-30-10, 30% in income, producing stocks, 30% in real estate or real estate equivalents, 30% in managed money, which means capital not entirely dependent on your own direct decisions, 10% in cash or cash equivalents, which may include cash, short-term reserves, gold, Bitcoin, or other liquid reserve, like assets depending on the investor's beliefs and risk tolerance. The purpose of this structure is not mathematical perfection. The purpose is diversification across decision types, asset types, liquidity types, and risk types. Many people become overconcentrated in the first thing that works for them. They buy one stock, it goes up. They add everything. They buy one property, it goes well. They put every dollar into real estate. They trade one strategy successfully. They scale it too fast. Then the market changes and the weakness appears. A durable wealth system does not depend on one asset doing everything. Income. Producing stocks can create dividends, option income, and long-term appreciation. Real estate can create cash flow, leverage, tax advantages, and inflation protection. Managed money can reduce dependence on your own judgment and give exposure to broader strategies, professional management, funds, Syndications or portfolios, you are not actively selecting security by security. Cash and equivalents give dry powder, emergency protection, and the ability to act when opportunity appears. The cash bucket should not be filled last. It should be built as you go. If you have $50,000 in stocks, you should also have a cash reserve. If you are building $1 million portfolio, the cash and equivalents bucket becomes meaningful. The purpose is not to maximize return every second. The purpose is resilience and optionality again. Liquidity reduces panic. This is why I would begin with stocks, but not end with stocks. The final destination is diversified. The first step should be forgiving. Now, one of the most dangerous mistakes in investing is copying someone else's chapter 20 when you are still in chapter 1. You see a person buying apartment syndications, using options, owning multiple rentals, executing 1031 exchanges, and borrowing against appreciated assets. You think, I should do that too, but that person may have experience, reserves, tax advisors, asset protection structures, financing relationships, and years of painful mistakes behind them. You only see the current move. You do not see the foundation. This is why copying successful people can be dangerous. When you do not know their sequence, they may be taking a risk they are prepared for. You may be taking the same risk without the preparation, same asset, different risk. That is how people blow themselves up. The right question is not what is that experienced investor doing? Now, the right question is what would that investor do if they were starting from my position with my capital, my knowledge, my liquidity, my income, and my risk tolerance? That is a much better question. Now, there is another cognitive bias that matters here. Michael Crichton describes something often called the gel man amnesia effect. The idea is that when you read an article about an area where you are an expert, you may see all the errors and oversimplifications. Then you turn the page and read about a field where you are not an expert and you suddenly believe the article is accurate. This happens constantly in investing. A tax expert reads a tax article and sees mistakes. Then the same person reads a real estate article and assumes it is accurate. A real estate expert reads a property article and sees nonsense. Then they read a stock market article and trust it. A business owner reads about their industry and sees errors. Then they read about crypto, AI, tax law, or macroeconomics and assume the summary is good. This is dangerous. Online content often makes complex strategies look simple. Real estate especially suffers from this. People show the rent and ignore the expenses. They say the property rents for $1,500 a month, as if that is the income you keep. It is not. A serious real estate investor underwrites conservatively. If a property rents for $1,500 a month, do not pretend you keep all $1,500 taxes. Insurance, maintenance, property management, vacancy repairs, and capital expenditures all consume cash. A rough conservative assumption may be that half of gross rent disappears before debt service. In that case, $1,500 becomes $750 before the mortgage payment. If the debt service is higher than that, you may not have positive cash flow. If the math does not work, do not do the deal, period. This is one of the most important real estate principles. People get seduced by gross rent. Wealth is built on net cash flow. Gross rent is vanity. Net cash flow is reality. If you ignore reserves, the property will eventually teach you, the roof will teach you, the tenant will teach you, the local government will teach you. The insurance company will teach you, the bank will teach you. Those lessons are expensive. Better to learn them before the purchase. Now, the same conservative thinking applies to stocks, though the mechanics are different. Do not buy a stock only because the story sounds good. Look at revenue, profit, dividends, debt valuation trend, analyst sentiment, and the durability of the business. If you are using options, understand the obligation you are taking. A cash-secured put can be a useful way to get paid while agreeing to buy a stock at a lower price, but only if you actually want to own the stock at that price and have the cash ready. A covered call can create income, but it can also limit upside if the stock moves higher. Options are tools. Tools are useful when understood. They are dangerous when copied blindly. This is why the early stage is about competence. Do not start with the most complex strategy. Start with the asset that teaches you without destroying you. Learn how stocks move, learn dividends, learn valuation, learn liquidity, learn your emotions, then expand. That is the sequence. Now, managed money deserves attention too. Many do. Yourself investors become overconfident. They think because they learned one area, they should manage everything. Sometimes that works. Sometimes it creates concentration risk. Managed money can mean hiring an advisor if your portfolio is large enough. It can mean using ETFs. It can mean using a professionally managed portfolio. It can mean syndications where someone else operates the asset. It can mean mirroring a strategy that is diversified in rules. The point is to decouple part of your wealth from your own active decision. Making this is important because no one is good at everything. A person may be excellent at selecting dividend stocks but weak at real estate markets. Another may be good at rentals but emotional in stocks. Another may be good at business but poor at portfolio management. The managed money bucket recognizes human limits. Diversification is not only across assets. It is across decision makers. That is a subtle but important point. Now, the 30-30-30-10 model also helps prevent catastrophic overexposure. If housing crashes, you are not entirely real estate. If stocks crash, you are not entirely equities. If managed money underperforms, you still have direct assets. If an opportunity appears, you have cash. No allocation model is perfect, but the purpose is to avoid being taken out by one bad environment. Wealth that lasts is built to survive different regimes. Inflation, deflation, recession, bull markets, bear markets, tenant problems, market crashes, job loss, tax changes, interest rate changes. The more your wealth depends on one narrow bet, the more fragile it becomes. Now, I want to return to the first question: should you start with stocks or real estate? My answer is stocks for most beginners. Stocks provide liquidity. Stocks allow smaller mistakes. Stocks activate learning through ownership. Stocks teach market behavior. Stocks help you build a base of capital. Stocks can create income through dividends and eventually options. Stocks help you understand risk without putting you into direct debt, tenants, and maintenance. Once you build competence and capital, then move into real estate more intelligently. Start with REITs if you need liquidity. Consider house hacking if it fits your life. Consider live in improvements if you are willing to do the work and understand the tax rules. Then, when you have enough reserves, knowledge, and risk control, consider direct rental property. Do not skip steps because someone else is making money in Chapter 20. That is the whole message. Sequence matters more than excitement. Now, there is another reason stocks can be the better first move. They reveal your temperament. If you cannot handle a 10% decline in a diversified stock position, you may not be ready for the hidden volatility of real estate. Real estate does not show you a daily price quote, so people think it is less volatile. In reality, the value can fluctuate, but the market does not mark your property every second. That can be psychologically helpful, but it can also hide risk. Stocks show you volatility immediately. That is a good training device. You learn whether you panic, you learn whether you chase, you learn whether you overtrade, you learn whether you can stick to a system if you cannot handle liquidity and visible volatility. Direct illiquid leverage may not be the right next step. The stock market is a mirror. It shows your emotional reactions quickly. Use that mirror before taking on bigger commitments. Now, some people will argue real estate builds wealth faster because of leverage. That can be true. Leverage can accelerate wealth. If you buy a property with 20% down and the property appreciates, your equity return can be much higher than the property's appreciation rate. Tenants can help pay down debt. Tax benefits can improve after-tax returns. Inflation can raise rents and asset values while fixed rate debt stays the same. That is powerful. But leverage also magnifies mistakes. If the property falls in value, if the tenant stops paying, if expenses rise, if interest rates reset, if you must sell at the wrong time, leverage works against you. The same tool that accelerates wealth can accelerate loss. That is why real estate can build wealth faster for someone prepared and destroy wealth faster for someone unprepared. The right answer depends on stage, competence, reserves, and execution. Stocks may build wealth more slowly in some scenarios, but they often provide a better learning curve and lower operational burden at the beginning. The question is not only what builds wealth fastest, the question is what builds wealth without taking you out of the game. Survival comes first. Then compounding. This is a core principle. Now, if someone already has a strong cash cushion, stable income, construction knowledge, local market expertise, legal support, and a conservative underwriting discipline, starting with a house hack or small property might make sense. There is no universal rule. But for the average beginner with limited capital and limited knowledge, stocks are usually safer as the first training ground. This is why the answer is probabilistic. Most people should start with stocks. Some people can start with real estate if their situation fits. Everyone should end up diversified over time. That is the balanced view. Now, let us talk about cash. Cash is often criticized because it may lose purchasing power to inflation. That is true, but a cash reserve is still essential because it prevents forced errors. In a real estate portfolio, cash pays for repairs, vacancies, and emergencies. In a stock portfolio, cash allows you to avoid selling during downturns and buy when prices fall. In life, cash protects you from turning a temporary problem into high-interest debt. Cash is not always meant to maximize return. Cash is meant to preserve optionality. A good investor understands that different dollars have different jobs. Some dollars are for growth, some dollars are for income, some dollars are for protection, some dollars are for opportunity. The 10% cash or equivalence bucket exists because opportunity and danger both require liquidity. If you have no cash, a market crash is only pain. If you have cash, a market crash can become opportunity. If you have no cash, a vacancy is a crisis. If you have cash, a vacancy is a cost. Same event, different system. That is why cash matters. Now, I want to make the stock income idea clearer. A stock can pay you in more than one way. First, you may receive dividends. Second, if you use cash, secured puts properly, you may get paid to agree to buy a stock at a price you like. Third, if you own shares and use covered calls properly, you may get paid for giving someone else the right to buy your stock at a higher price. Fourth, if the stock appreciates and you sell, you may realize capital gains. This does not mean everyone should use options immediately. Beginners should be careful. Options can be misused, but the concept is important. A high-quality stock can become an income-producing asset, not merely a line on a screen. The idea is to become a stock market landlord. You want to own productive assets and collect income from them. Just as a real estate landlord collects rent, a stock investor can collect dividends and premiums if they understand the tools. But again, tools must be learned slowly and responsibly. The first objective is competence. Now let's compare this to direct real estate income. A rental may collect $1,500 a month in rent, but the investor must subtract operating expenses, capital reserves, vacancy management, and debt service. Only after those costs does true cash flow appear. Many new investors ignore this and think rent equals income. It does not. Similarly, a stock dividend is not free money. The company must generate profits or cash flow to pay it. A dividend that is not supported by business fundamentals can be cut. That is why the filter matters. You want dividends from companies with long histories, stable revenue, reasonable payout ratios, and durable businesses. In both stocks and real estate, the principle is the same. Cash flow must be real, not imagined. Now, asset protection and tax planning become more important as capital grows. A beginner may start with a brokerage account and a few stocks. Later, as wealth grows and real estate is added, legal structures may matter. LLCs, insurance, trusts, tax planning, depreciation, 1031 exchange, and estate planning become important, but these are not reasons to delay the first step forever. Learn in sequence. Do not create a complex structure before you have assets that justify it. Do not buy assets that require a structure you do not understand. Build competence, then complexity. This is another principle. Complexity should follow necessity, not ego. Now, let us examine why people get pulled into the wrong first move. They see a story of someone making money and they copy the surface. A person bought real estate and became wealthy. So they think, I should buy real estate, but they do not see the hidden variables that person may have bought in a good market. They may have had reserves, they may have had construction knowledge, they may have bought before prices rose, they may have had a strong income, they may have had family help, they may have survived early losses, they may have tax knowledge, they may have partnerships. You see the outcome, you do not see the path. This is why copying outcomes is dangerous. You need to copy principles. The principle is not buy what made someone else rich. The principle is build competence. Preserve liquidity, diversify, avoid overconcentration, underwrite conservatively, and increase complexity only when you have the capital and skill to manage it. Those principles apply to both stocks and real estate. Now, the same issue happens with stocks. People see someone make money on a speculative stock and copy the ticker. They do not understand position sizing, entry price, risk tolerance, tax situation, time horizon, or exit plan. Then the stock falls and they panic. Again, copying Chapter 20, a principle-based investor asks, what is appropriate for my current stage? That is the key. If you are starting with $10,000, the right move may be quality dividend stocks and cash reserves. If you have $150,000, you may be building the first version of the 30-30-30-10 structure. If you have $1 million, the allocation can be more mature. If you have significant expertise, direct real estate and managed strategies can expand. The strategy evolves as the person evolves. Now, there is another important idea. Your first investment should make you smarter. That may sound simple, but it is profound. A bad first investment teaches fear, confusion, and distrust. A good first investment teaches curiosity, discipline, and pattern recognition. If your first move is too large and too complex, the pain can make you avoid investing for years. If your first move is small and educational, even the mistakes can make you stronger. This is why starting with a small position in quality stocks can be powerful. You learn without being consumed. You build attention. You gain vocabulary. You see how markets react. You develop pattern recognition. Then you move forward. Investing is not only about the asset, it is about becoming the kind of person who can own assets well. That is the deeper lesson. Now, real estate will eventually teach you too. It teaches negotiation, local markets, financing, repairs, tenant psychology, tax law, insurance, and operations. Those are valuable lessons. But the tuition can be expensive if you start before you are ready. That is why the path may be stocks first, REITs and house hacking next, direct real estate later. This is not anti-real estate, it is pro-sequence. Now let us imagine two people. The first person has $30,000 and buys a distressed rental property in a market they do not understand. The property needs repairs. The tenant stops paying, the roof needs work, the person has no reserves. They borrow on credit cards to solve problems, stress rises, they sell at a loss, or hold a property that consumes cash. They conclude, real estate is terrible. Real estate was not necessarily terrible. The sequence was terrible. The second person has $30,000 and starts with quality dividend stocks, learns valuation, builds liquidity, grows a cash reserve, studies REITs, reads real estate financials, house hacks later, and eventually buys a rental with enough reserves and conservative underwriting. They conclude real estate is powerful. Same asset class, different sequence. That is why order matters. Now, let us consider the final allocation in practice. If someone eventually has $1 million of investable assets, a rough framework might be $300,000 in income, producing stocks, $300,000 in real estate or real estate equivalents, $300,000 in managed money or delegated strategies, and $100,000 in cash or equivalents. This is not rigid. A person's age, income, taxes, goals, risk tolerance, local market, and skills may change the numbers. But the structure teaches balance: income, producing assets, real estate exposure, delegated or diversified management, liquidity, and reserves. This is a system designed to last, not a bet. That is the goal. Wealth that lasts, not wealth that appears quickly and disappears when one assumption changes. Now I want to talk about the role of managed money more deeply. Some people hear managed money and think fees. Fees matter. Paying high fees for poor performance is a bad idea, but the managed bucket does not have to mean an expensive advisor. It can mean low-cost ETFs, target date funds, robo-advised portfolios, model portfolios, or professional management when appropriate. The purpose is to keep part of the portfolio from being controlled entirely by your own emotions. Many investors are their own biggest risk. They sell low, they buy high, they chase, they freeze, they become overconfident, they become fearful. A managed or rules-based bucket can reduce that behavioral risk. This is why low-cost index funds can also fit into the managed category. For some people, you are not selecting individual stocks, you are letting a system hold the market for you. Again, the principle is to reduce the number of ways your own mistakes can damage your future. Now, some people will object that dividend stocks are too slow. They want fast growth, they want aggressive technology, they want crypto, they want leverage. They want the thing that can double quickly. That desire is human. But early wealth building is not only about maximum speed, it is about building the base from which future risk can be taken intelligently. If you build your first capital base through stable income, producing assets, you gain confidence, cash flow, and knowledge. Later, you may allocate a smaller percentage to higher upside opportunities. But if your entire base is speculative, one bad cycle can reset you. This is the reason for boring assets. Boring assets give you staying power. Staying power gives you the ability to take opportunities later. The person who survives gets more chances. The person who blows up does not. Now, I want to close the loop on competence. You can become competent much faster than you think if you focus. 20 hours of deliberate attention can change the way you see investing. You can learn basic financial statements. You can understand dividends. You can learn what cash flow means. You can compare valuation. You can study a REIT. You can learn how a rental is underwritten. You can learn what a capex reserve is. You can learn why liquidity matters, but you need skin in the game to make it stick. A small stock position can make the lessons relevant. A small REIT position can make real estate financial statements relevant. A small cash secured strategy, only after proper education, can make options relevant. This is not gambling. This is structured education. The danger is when people skip the structured part and go straight into size. Size before competence is how wealth is destroyed. Competence before size is how wealth is built. Now, the final answer to the original question is clear. Stocks or real estate, if you are starting. Stocks, if you are building durable wealth, both if you are creating a long-term system, add managed money and a cash bucket. If you are entering real estate, do it in sequence. House hack if it fits. Use live in improvement strategies. If you understand the rules, use REITs as a liquid real estate classroom. Buy direct rentals only when you can underwrite conservatively and survive normal problems. And never put all of your capital into a move you do not fully understand because someone else made it look easy. That is the principle. Investing is not about chasing what is visible this week. It is about building a system that survives for decades. The frequency illusion will keep showing you whatever your brain has started noticing. If you are interested in real estate, you will see real estate opportunities everywhere. If you are interested in stocks, you will see stock opportunities everywhere. That does not mean all of them are good. Attention must be guided by principles. Start where the downside is survivable. Build competence through ownership, protect liquidity, use conservative underwriting, diversify across asset classes and decision makers. Keep cash, move into real estate when you have the knowledge and reserves. Do not copy someone else. Chapter 20, build your own Chapter 1 correctly. That is how wealth is built faster in the only way that matters. Not by taking the biggest risk immediately, by compounding skill, capital, and judgment in the right order. Because the fastest path is not the one that looks exciting. The fastest path is the one that keeps you alive long enough for compounding to do its work.